So the ongoing Iran war continues to boost oil prices while stocks slipped and gold lost some of its appeal as a safe haven. Let's go to David Dietz. He's chief investment strategist at Dietze Wealth Management and joins us now to talk about this. David, thanks for joining us today.
Good afternoon. Good to be with you.
So we're used to seeing investors flock to gold when things are uncertain. Gold down today. So how do you explain this?
Yeah, well, I think gold has moved just a little bit too much too far. I'm looking at various publicly traded portfolios of gold mining stocks. They've nearly tripled in the last year. Gold itself is up about 28%. And I think what's interesting now is we're seeing a flight to safety that includes the U.S. dollar. So right now, I think investors, traders, central banks are also seeing the U.S. dollar as a potential repository for safe haven and not wanting to chase continually this the gold. The other thing I've been noticing is increasingly I'm seeing new mining discoveries with gold up nearly doubled over the last few years here. Mining ventures worldwide now are looking for new areas where they could find the precious metal and where it's not profitable to produce. Where there's more supply, prices are going to come down a little bit. So I think that's one reason gold's taking a breather here.
Okay, let's talk a little bit more about some of the other sectors. We're seeing travel stocks affected, of course, with what is going on in Iran. We're getting questions about whether or not to hold in this sector. Would you, if you're already invested in travel, hotels, that kind of thing, would you stay invested?
It all comes down to your views on the war with Iran. I think there's two key questions. One is, how long is it going to last? Is it going to be 4 to 5 weeks, as Mr. Trump has said? Or is it going to be much longer? As he said, it could also happen. The other key thing to watch, of course, is what do the other superpowers do? Russia and China. Russia may be very happy with this war going on for some time. Why? The energy prices are going higher. That's a key export of them. And of course, they don't need to ship out of the Strait of Hormuz. They can ship in using other channels. China, on the other hand, desperately wants that strait opened up. To what extent will they get involved, either as a peacekeeper, or some people have said kind of in a sinister manner, maybe they use this as an opportunity to pick a little fight here with Taiwan while we have all our assets there in Iran. Either of those things with Russia trying to getting involved in an adverse way could make this a much worse situation than it is now.
Okay, oil, as you mentioned, gaining, which is good, of course, for Canadian producers, but do you see it as sustainable?
Again, how long is this war going to last? You really do have the risk that if all of a sudden Iran puts down its arms, the strait opens up, you could see oil retreating rapidly, particularly if this has been such a shock that it's going to take some of the edge off the global economy. And so I wouldn't chase energy stocks right now. I mean, it all goes down to, do you want to buy your snow shovel in July or do you want to buy in the middle of the blizzard? That's why I'm a little cautious about buying energy stocks right here.
Okay, so then what sectors are you looking to right now?
So, we really like the healthcare sector. The area has been very muted here out of concerns over excessive regulatory control coming from Washington, a lot of pushback from patients and customers as to the treatment that they've gotten from drug companies and health insurers. We think those companies will have long-term positive growth prospects. America, for example, is aging very rapidly. Seniors need more health care, and the stocks are selling at very attractive valuations with good dividends. So that's an area that will sidestep conflicts in the Middle East and could offer investors good returns.
Okay, so under that banner, you like UnitedHealth, which has been pretty beaten down and hasn't seen much of a recovery yet.
No, it hasn't, but the earnings per share are projected to grow $18 this year, $20 next year. They have a 30% market share. What has happened is they've gotten a lot of pushback because of probably valid concerns as to whether they've delayed treatment, denied treatment in an unfair fashion. They, of course, had a change in the leadership at the top. They had terrible news with the assassination of one of its employees. There's concerns that the United States comes in with a heavy regulatory hand. But at the end of the day, there's no solution for the U.S. healthcare system other than health insurance. UnitedHealthcare, with the 30% market share, is by far the largest. You have to work with them. You have to be involved with their networks. We think with the stock now by more than half over the last year, but earnings per share continuing to go up. And then, you know what insurance companies do if they're not making their target profits? They just keep raising premiums. And unfortunately, we don't have much choice here.
Okay, let's get to another one of your pick, which is Apollo Global. So this is an asset management company. What do you like about them?
They're one of the largest alternative asset managers in the world with close to 1 trillion under assets. Their fees for managing those assets are going up more than 20% per year. They're heavily diversified in all areas of the financial markets, but they have dropped. Well, they were 171 as recently as 16 months ago. Now they're about 111. They dropped just 17% in the last month. Why? Because of investor concerns about their exposure to debt from so-called software companies that may be adversely affected by developments in AI. We think that is very much an overreaction. We think they're expert asset managers. They have stuck with very high quality loans to the software companies, not recent vintage, but more established companies that established themselves years ago. So we think that, with a company that's going to be growing more than 20% a year, now trading at about 12 times earnings, this is an opportunity to get exposure with one of the most advanced asset managers in the world.
Okay, I don't quickly want to get to your third pick, which is Kraft Heinz, more of a consumer staple. What do you like about them?
A 150-year-old company with iconic brands, Kraft cheese, Heinz ketchup, of course. They have not done well over the last decade. Warren Buffett, Berkshire Hathaway has taken a position. Kraft Heinz proposed to split itself into international and domestic. They got a lot of pushback on that from Berkshire Hathaway. They have killed that proposal. They're going to enhance marketing. They're going to try and buy back more stock. They need to boost margins and get sales going again. But I think with the current 6% dividend, which we think is well covered, trading at about 11 times earnings, this iconic brand can get back on its feet.
David Dietz, got to leave it there, but thank you for joining us. Appreciate it.
Thank you.